Welcome to the Hurst Trading Room Live. My name is David Hickson, and it is the 22nd of February 2016. As always, before we take a look at the markets, make sure that you have read and understood these discussions. I thought that I would really switch things around a little bit today. Usually I tend to focus on a fairly short period of time. I start looking and I look ahead a fairly short period of time. And I thought today what I would do is something really quite different, and take a real step back and take a look at a really big picture and ask a few questions about what's happening in the really long term. I hope this is going to encourage some interesting discussion, because the first thing I should say is that I'm not really generally a very long-term analyst. I tend to focus my analysis on tradings that I'm making, which might be largely intraday, and of course sort of swing trading. I tend to make trades over fairly short periods of time, and so long-term analysis has always been something I found interesting. But I know there are many analysts out there who are more experienced at a much longer term consideration of what the markets are doing. So I'm hoping this will start some interesting discussion and get some people contributing to that discussion and sharing their knowledge. Let's take a look. First of all, this is the S&P 500 going all the way back to 1950, and in fact, this is the log scale. You're probably used to looking at charts a little bit more like this. Okay, so that's a standard chart where the scale on the right-hand edge of the screen, over here, going up like that, and that's called a linear scale, I believe. And most people present financial data on a linear scale because it shows an increase in a way that is more easy to relate to on the chart. But it's very deceptive. Looking at these charts, when I started looking at these charts, I would often wonder how people back in the 1950s, 60s, and 70s made any money trading, because the market never seemed to go anywhere. It just seems to crawl along the bottom of the chart. And of course, when you're performing a cyclic analysis, that's extremely deceptive when you look at a chart like this, because you can't see any cycles there. Let's face it. There's nothing happening for 30 years, and then all of a sudden the market seems to come to life, and it springs upward, and then we get some good bit of cycle activity, and then then it springs upwards again. So looking at a chart on a linear scale, a long-term chart, is not really very useful for a cyclic analyst, and that's why whenever I look at a longer-term chart, I always switch it to a logarithmic style chart. And the logarithmic style chart really presents the percentage move. I see a few people coming in there. Hello, Elaine and Chris. So the logarithmic chart presents a percentage move, which is really much more useful. I believe it's more intuitive. And so, for instance, here is the 100 level in the S&P 500. When you move up to this line over here, that represents a doubling in the level. So from 100 to 200. Then when you move up the same distance again on your chart, you go up the same distance, and that is again a doubling in price. So we doubled from 100 to 200, from what was that, 1981 to the late 80s, I think, and then we doubled again to 400, and then we doubled again to 800, whereas 800 is the same distance up on the chart, and then we doubled again to 1600, which is the peak over here, and we haven't doubled up since then. So a logarithmic chart is really useful because it presents a better way of looking at things in terms of a cycle perspective, because it shows a percentage price change rather than the actual numbers. And of course, the actual numbers mean less as time moves on. I mean, a 20-point move in the S&P 500 today means a very different thing to a 20-point move in the 1950s, of course. I believe to look at logarithmic chart and speak about percentages instead. Okay, so let's have a look at the analysis. And so I'm not going to dwell too much on the exact positioning of these things. I'd just like to point out the bigger picture so that we can begin to build a picture of what we're expecting to happen now, and why the markets have been going down, why they might continue going down, and when we can expect a bounce and what we can expect to happen after that. Okay, so first of all, let's start with this really prominent trough. As a cycle analyst, you'll generally find that you always start with a really prominent trough on the chart, because it shows something that is clearly happened in the market, and that was the trough in March of 2009, of course, in the S&P 500. And you can see that according to this analysis, that trough has been marked as a trough of this red cycle here at the foot of the chart. Now that red cycle is the nominal 18-year cycle. And if I can focus my eyes on what that average length is, I think that average length is 18.5 years. My eyes aren't as good as they used. So that's an 18.5-year cycle. Now, I'm going to come back and speak about nominal models again in a minute, and we're going to take a look at a slightly different picture. But for now, that's the 18-year cycle, red cycle that is bouncing along the bottom of the chart over here. The next shorter cycle, this slightly paler red, almost orange-colored cycle, is the 9-year cycle, the nominal 9-year cycle. I say nominal 9-year cycle because we call it the 9-year cycle. The name of the 9-year cycle, it does average out to about 9 years, but we call it the 9-year cycle just for ease of use, rather than talking about, the 8.935-year cycle or something like that. Okay, so the two cycles you can see the semicircles for are the 18-year and the 9-year cycle. So what does that tell us? Well, it tells us that the trough in 2009 was a trough of the 18-year cycle. So most of the analysis that I perform, and let me quickly show you a chart that you're familiar with. Whenever I speak about the S&P 500 generally, I end up showing you a chart rather like, okay, this is the chart that I use mostly for my trading decisions in terms of making trades, not intraday, of course, but for a few weeks or a few months. This is a chart of the S&P 500, and it shows data only back to 2008. And these are the 18-month cycles bouncing along the bottom of the chart. And most of my trading decisions on this chart. Today I thought it would be really interesting to really step back, take a look at the longer term picture and see where we are in the longer term picture. Because whenever I look at this chart, I end up saying, oh, well, the 9-year cycle is clear, not the 9-year cycle, I beg your pardon, the trough in 2009 was clearly a trough of at least 18-month magnitude, right? Because there's an 18-month cycle trough that formed at that point. But it was also obviously a much longer magnitude trough, and it was clearly a 54-month cycle trough as well, because there is the 54-month cycle trough that I believe occurred in 2012. And in the webinar that we did 2 weeks ago, I mentioned that it was almost certainly also a trough of the 9-year cycle. So at some point you have to ask yourself, okay, so you keep labeling this trough in 2009 as being longer and longer and longer. And the reason for that is because when you're a cyclic analyst, it's important that you know that a trough is of at least a certain magnitude in order for it to impact your trading. And in order for that trough to influence my trading decisions in 2009, it has been adequate for me to see that trough and to consider that trough as a trough of at least 9 years magnitude, potentially even longer. And I spent quite a long time saying that to myself. Well, that's a 9-year trough, potentially even longer. So now, in today's webinar, I'd like to discuss whether it is how much longer. How much longer is that cycle that formed the trough in 2009? So here you can see, according to this analysis, as I've mentioned, it's saying it is at least 18 years. So that's the red cycle, the 18-year cycle. And if we go back 18 years to the previous 18-year cycle, you can see that was over here. I think that's in 1990, something like that. And you could debate the exact positioning of that trough. You might want to squeeze it over to 87 or squeeze it for 94, but somewhere around there was clearly a trough of what we would call the nominal 18-year cycle. And so if we go back another 18 years, then we get back to 1974, or I should say go back another 18-year cycle, not go back another 18 years. If we go back another 18-year cycle, one of these red semicircles, then we get to this trough in 1974. Now, 1974 was a very important stock market trough. I believe that most Elliott wave analysts consider that to have been a very important, is it a fourth wave? Anyway, it's a really important trough over there. And so if we look at the previous two 18-year cycles, which was the most prominent of them? So over here, at 2009, we go back 18 years. We end up there. We go back another 18-year cycle. We end up over there, 1974. You know, it looks as if the next longer cycle should definitely be drawn as a semicircle like that. I think you'll probably, it doesn't seem likely that the next longer cycle should do something like that. Okay, so it seems most likely that our next longer cycle should be something like that. But now here we have an interesting question to ask, because Hurst defined cycles all the way up to 18 years, and he'd say anything, as far as I know, about cycles longer than 18 years. Is there a 36-year cycle, or is there a 54-year cycle? And it would make for very nice symmetry, of course, if there was a 54-year cycle, because in our nominal model we have an 18-month and then a 54-month cycle. And so wouldn't it be great in terms of symmetry if there was an 18-year and then a 54-year cycle? Well, in order to determine that, we would need to go back even further. So if we step back further in this chart over here, we get to this rather questionable position of a trough in 1953. It's very questionable because it's right near the left-hand edge of the chart, and we don't really know what happened before that, because my data doesn't go back before that. So what do we do? Well, we can try and find more data, but okay, there's an interesting comment from John. He thinks 1974 makes sense as a 36-year because of the potential mid-channel pause from 1987 to 1990. You're jumping ahead, John. Absolutely, I think that's part of the argument I'm going to try to make. So so I'm going to hopefully get there in a minute. If I get there, I have to get there eventually. But that's and Craig says, isn't 54-year the idealized K wave? Yes, I believe it is, Craig. And of course, the Kondratieff. How long is the Kondratieff cycle? It's it varies in length. The exact relationship between between K wave and Hurst cycles waves, I haven't done a lot of research into, and I don't know how closely they correlate, but there is definitely a correlation between them. But let's just see if we can take a step back. I don't have data for the S&P 500 going back that far, but luckily I had it for the Dow Jones Industrial Average going back to 1897. So and I hope you can see that. It's so, I mean, the dates are so tiny on my screen, I wouldn't have a chance of identifying them. But here's the Dow Jones Industrial Average going all the way back to 1897. So this really big move here is the big crash before the Depression, 1929 to 32. So that's that really big move down. Here is 2009, March 2009, and where are we? Here is 1974. Okay, so that is 74, and let's see if I can use this pen. Oh, my pen seems to have given up the ghost. I'll have to use a mouse. That is 29, peak. Okay, let me just do this again. Okay, and here we have 1974, and this is 1932. That drop down over there. Okay, but in terms of us counting our cycles, again here, the longest cycle here is the 18-year, the nominal 18-year cycle. And we go back from 2009, we're back 1, 2, and yes, I know they're a bit sort of oddly shaped, but we go back 2 cycles and we get to 1974 as we did in the S&P 500. So that is 18 times 2, which is, which is a nominal 36 years. So so we're looking at possibly a 36-year cycle there. Then we go back another 1 to see whether we can find a good 54-year cycle, because of course the 54-year cycle would necessarily contain 3 18-year cycles. We go back 1 more 18-year cycle and we get to this period over here, where we really just had a big strong bull market through the 50s and 60s, late 40s even, and there aren't any clear cycle troughs over there. So the 54-month cycle, 54-year cycle doesn't really make sense. But we go back another nominal 18-year cycle for this jump over here, and we get to 1932. 1932 to 2009 is, of course, 77 years or 78 years, depending, where you count it in terms of the where in the year you're measuring it. On CentiTrader, we can actually measure the time, and should try and get that peak correct. So if we measure it like that, you can see it during out at 76.31 years. So just looking at this chart, and if one chart is by no means clear evidence is a 36-year cycle as opposed to a 54-year cycle, but looking at this chart, it seems to make sense that we have a 72-year cycle and a 36-year cycle. So we would have a 36-year cycle and another 36-year cycle. And might we even have a 72-year cycle? Well, that's a pretty extraordinary consideration. And I'm not suggesting that that is necessarily what's happening, but looking at this chart, we potentially formed a nominal 72-year cycle low in 2009. I'm hoping that's going to encourage some really interesting consideration and debate and analysis, because that's a really interesting idea. And John says 1896-32 was probably a 36-year cycle. So we've got some good evidence for 36-year cycles. Making the leap to 72 years is a bit much even for me to consider that maybe we formed a 72-year cycle trough in 2009. It seems like a very bold statement, but I throw it out as something for you to consider and something for you to think about. Now, let's go back to the concept, and I like looking at the S&P 500 just because I trade the S&P 500 more than the Dow Jones, so I'm more familiar with it. But if we have a look at the move from 1974, here we go, up to 2009, if I zoom in there. Now, in our last webinar 2 weeks ago, I spoke about the mid-channel pause. This is what John referred to earlier in his comment. The mid-channel pause is what tends to happen when you're moving up in a cycle. So your cycle moves up like that, and it forms an M shape and comes down again. And so, of course, this is the starting trough, and this is the ending trough of the cycle, and this is the mid-trough. But the mid-channel pause is a pause in price action that happens at this level over here. Okay, and as John mentioned, there was a good example of a mid-channel pause, 1987 to 1990. I mentioned last week that mid-channel pauses are often contracting. They often take the shape. It can also take the shape of a rising wedge or any kind of contraction in price movement. Generally, if you get contracting angles, they don't have to be contracting in that way. They could be contracting upwards or contracting downwards in a sort of a declining wedge. And so there potentially is a very good example here of a mid-channel pause, 1987 to 1990, which further, as John mentioned, further corroborates the idea that 1974 was a 36-year cycle trough. Okay, let's having taken a step back. Let's ask ourselves what that really means. Well, what it really means is that price has been bouncing out of the 2009 trough, and that is a trough of probably, I believe, about 36-year magnitude, maybe even 2-year magnitude. See, I'm even reluctant to say it out loud because it seems like such a big statement to make. But it's bouncing out of a really big trough, and so there's little surprise really that the market has bounced so much. But now what's happening? Well, the cycle keeps beating, of course, and the market is turning down. I've been speaking for some time, both in these webinars and in blog posts I've been making and so forth. I've been speaking about the fact that a 9-year cycle peak was due. I started writing about this a long time ago, a year and a half ago probably, that we were due for a 9-year cycle peak, and now prices are definitely heading down into a 9-year cycle trough. And if you have a look at the foot of this chart, and let's just zoom in here, let's just step right forward quickly, and here you can see prices are heading down now, and they're heading down into this 9-year cycle trough. And if we look at these semicircles, you can see this is the 9-year semicircle. It's indicating that that 9-year cycle trough is expected to form somewhere. That nest of lows is centered around about the middle of next 2017. Okay, so I see Hube says, why not look at the analysis summary panel periodograms? Yes, we do, in terms of finding evidence for cycles. I do, Hube, is I'll come back to that and talk a bit about those periodograms for those who don't know what they are. Let me just finish this train of thought, but remind me if I don't get back to them before the end of the webinar. So definitely heading down into a 9-year cycle trough at this point. And so that presents us with a bigger picture of what's happening at the moment. And in terms of certainly the trading that I'm doing, that's really all that matters to me. Whether it's bouncing out of a 72-year cycle trough in 2009 doesn't really affect my trading materially very much in terms of what I'm doing over the next few weeks, over the next few months. But that is what this analysis is saying, is that we're heading into a 9-year cycle trough, which is expected probably sometime next year. Now, I've mentioned the whole nominal model, and we're looking at 9-year cycles and 18-year cycles and possibly 36 and so on. I did a webinar with John in, I think it was November last year, and we did a very interesting argument that in fact the nominal cycle that we're working with, which is the default nominal model, I call it the default nominal model. It's the nominal model that Hurst actually wrote down in his Hurst Cycles course, which he published in 1972. So, that's a 40-year-old model, and possibly another nominal model is active at the moment in the market. And so ever since that webinar, I've been really interested to follow different analyses with that shorter nominal model. Now, this nominal model shortens all the cycles. So instead of 18 years, we're looking at a 4-year cycle here. And instead of 10 years, we're looking at a 7-year cycle. So it implies that the cycles have shortened recently, and that therefore the nominal model we should be working with right now are a shorter wavelength. Nicholas says if 2009 was a low for 18 and 36-year cycles, this low might come early. Absolutely, Nicholas. This low for the 9-year cycle might come early. You rise to the house. That's exactly where I was sort of getting to. I was taking a long time to get there, but yes, absolutely, this 9-year cycle might come early, and might it even be a mid-channel pause? But I'm going to get there, and I'm going to show you something I think is quite interesting with the South African market. I just want to quickly show you, this is an analysis performed using the different nominal model that John suggested. The first thing that I should point out, if we ignore the period before 1974, the first thing that I should point out is that there's not a great deal of difference in these analyses. I won't bore you with all the details and go into too much detail here, but the basic points are the same. We've still got a really clear and obvious 36-year, or perhaps it would be a 28-year cycle trough in 2009, and we've got a 54-month, or it would be a 42-month, I think, according to this nominal model, sometime in late 2012, early 2013. Those differences those aspects of the analysis are very similar, so there aren't really many differences there. It's when you're working with a different nominal model, you do tend to get slightly different things happening in the near term. So let's just zoom right in now, having taken a look at such a big picture, and let's zoom right in and take a look at what is expected to happen in the near term, or for the move down into the 9-year cycle trough. Now, here is the circle for the 9-year, or in this case, because this is the shorter nominal model, we should call it the 7-year cycle trough, but it's the same trough I'm speaking about. I hope that makes sense, that doesn't confuse you. It's the same cycle in the list of cycles that we're considering, somewhere between 6 years and 12 years. So it's a 7-year or a 9-year cycle, and so there's that trough. And as you can see, it's synchronous with a 54-month cycle trough and then an 18-month cycle trough, and that is all happening sometime in about September of next year. And you can see here is an 18-month cycle trough in October of 2014, and what I would call a 40-week trough in August of 2015, and so now we're expecting price to come into this 18-month cycle trough over here, and then we have one more 18-month cycle before the really big 9-year cycle trough. I see a comment from William. Hurst's digital filters are flexible enough to account for the modulation in the average period of price waves. Gosh, that sounds a little complex. I think okay. So I think William's referring to the modulation in the average period, so the change in the average period of the price waves, and that the digital filters that William uses. He publishes a lot of work with the digital filters, very interesting in terms of tracking the current wavelength and what the current wavelengths are. Okay, so so what are we expecting? Well, according to this analysis, using the shorter nominal model, we're expected to find an 18-month cycle trough somewhere fairly soon, and then we're going to have an 18-month cycle play out before the 9-year cycle trough actually forms. However, as Nicholas pointed out, if the 2000 low was a very long trough, then we could expect the 9-year cycle trough to occur early. And you notice these lines to each side, what we call the whiskers, the circle and whiskers. Here is the start of the line for the 9-year cycle, indicating that actually we should stand by for the fact that the 9-year cycle trough could occur, and it could occur earlier than expected. Okay, that line indicates the range of possible time. So it's not impossible that 9-year cycle trough could occur early. Now, before I speak more about that, let me just go to back to the other nominal model and zoom in on the same time period and show you how, even though we're using a different nominal model, in fact, there's very little difference at this scale of the analysis, which is why I enjoy experimenting with different nominal models. But I must say, I find for most of my trading, I tend to stick with the default nominal model because it's worked for me over the years. But here is the 18-month cycle trough, also in October 2014, a 40-week cycle trough in August of last year. And I know we could debate the breakdown of these cycles, and I'm going to make a point about that in just a minute. Here again is the 18-month cycle trough nest lows, which is expected soon. And so we're expecting an 18-month cycle trough soon, and then a move down into the big 9-year cycle trough, which is expected also roughly the same time, perhaps a little bit earlier, July, August, maybe September of next year is when the 9-year cycle trough is expected. But I would like to point out something very important. Here is the whisker for the 9-year cycle trough, indicating that 9-year cycle trough could have occurred. But let's just zoom in even further and look at this most recent 40-week cycle. Do you notice this whisker for the 18-month cycle trough? Do you see when the 18-month cycle trough was expected? The 18-month cycle trough is expected, according to this analysis, on the 10th of March. Now, the 10th of March is in only 2 weeks' time. Okay, so something interesting with your Hurst cycles analysis, and I do believe it's something that you need to be aware of. I even invented a name for it because I like names for things, and the name I invented for this is the problem of counting cycles. And let me try to explain for a moment what I mean by that. And let me just zoom out again. The problem with counting cycles is something that happens in all analyses. Okay, what happens is you start with the bigger picture, and let me just zoom out again to let me just go all the way out to here. So you start with the bigger picture, and then as you perform your analysis and as you refine your analysis, you start identifying the shorter cycles. So in your analysis, you would have identified 2009, March 2009, as a trough of the 9-year cycle at least, let's say, or the 18-year cycle at least. So then you try and find the shorter cycles, and you look for a 54-month cycle. Now you're looking for a 54-month cycle in this period over here. Can you accurately, with conviction, place the 54-month cycle there? No, you can't. I don't believe any analyst could really, because these troughs that you see here are all so insignificant, tiny little troughs. It's really difficult to place correctly the 50-month cycle trough in there. So what you do is you look at a shorter cycle. you find the 18-month cycle. Then you look at a shorter cycle, you find an 18-month cycle, and you look for the next 18-month cycle. And you've again got a range to choose from, but you pick one of them, and because you've picked that one becomes the 54-month cycle. What happens is, as you're heading towards a trough, as we are now, we're heading towards a 9-year cycle trough. What happens is you start counting off cycles. So it's the 54-month cycle, and therefore the next 54-month cycle trough must occur over there. Then you find the next 18-month cycle and you position it there. Therefore the next one must be over here. Then you find the 40-week cycle trough and you say it must be there. Do you see how you're going shorter and shorter and shorter with your cycles, and you're trying to identify them? And as you identify the shorter and shorter cycles, you are refining or sometimes pushing forwards or pulling backwards the estimated time for the next cycle trough. And of course, that's why you get these sometimes very jagged nests of lows. A perfect analysis will show you a really beautiful stacked nest of lows like this, with everything stacking up on top of it, and it's all looking wonderful. And that's your perfect nest of lows. In reality, however, most of the time you get very staggered nests of lows. And the danger is that you've been counting cycles, you've been counting shorter and shorter cycles, and you find yourself saying, no, there must be at least one more 20-day cycle before that 9-year cycle trough is due, because I've counted my 20-day cycles and there have been only X number of them, therefore there must be one more 20-day cycle. That's a big danger as a cycle analyst, because if you've incorrectly identified any one of those 20-day cycles, then your counting of the cycles has been wrong. And so that's why it's very important, I believe, to keep an eye on these circles and whiskers, of course, these lines and circles for the cycles, and bear in mind that's when that 18-month cycle trough is expected. Yes, we identified this trough here as the 40-week cycle trough, but the 18-month cycle trough on the 10th of March. What if this 40-week cycle trough positioning is wrong? And you might, I don't know if you remember back to that time in August, September last year, there was a bit of debate amongst Hurst cycle circles about whether the 40-week cycle trough should in fact be placed back there in July, I think it was. And I think there are still some analysts, some of you are probably here, who believe that the July positioning of the 40-week cycle is a better position for the trough. So my point is, you have to be very careful of counting shorter and shorter cycles, because then what happens is you build up an expectation that because you've only had a certain number of cycles, you can't have a particular trough can't occur yet. So I believe, in terms of this trough that's happened over here, there was a nice trough that happened there. Where was that? Was that just last week, I think, or 10 days ago or so? It's quite possible that that is the trough of the 18-month cycle, and we need to remain aware of that possibility, because there is the range of time that that trough could have occurred. I believe it was probably a trough of the 20-week cycle, and let me just show you the S&P 500 chart. I probably missed a few points there. Low to low, this is the longest 18-month cycle of the 2014 low since 2009, says John. So it's an 18-month cycle that is dragging on, so it is definitely becoming overdue. Najmuddin, are these the closing values of S&P 500? Yes, these are. That was a closing chart. It only had the closing values for each day. Let me show you. Okay, this is the chart that I normally perform my analysis on, and I can just quickly show you how, according to this analysis, this trough here in February looks very much like a 20-week cycle. You see that? Okay. So, this trough that formed, I think it was the 11th, that trough formed. I think that is almost certainly at least 20 weeks in magnitude, but we need to keep ourselves open to the possibility that that might actually be the 18-month cycle trough. And I know that for some people that's a very difficult concept when you're trading, because you want to know what the truth is. Is it 20 weeks or is it 18 months? Which one is it? And the reality is that you have to work with probabilities rather than certainties. And the probability here is that that is a 20-week cycle trough. The possibility is that it's an 18-month cycle trough. Well, no, the certainty that we have, or the certainty that I have, is that it is at least a trough of 20 weeks, but quite possibly it is the trough of 18 months. You can see on this chart, if my screen has refreshed, that this analysis has placed the 20-week cycle trough right up there in a sort of a straddled position. An interesting thing we could debate for some time, but it doesn't seem such a good placement for the 20-week cycle trough, in my opinion. I might be wrong, but prices are bouncing out of a 20-week cycle trough or an 18-month cycle trough. And so what am I expecting to happen? If this is the 20-week cycle trough, bounce out of the 20-week cycle trough, come down and form another low here in July, August of this year, and that will prove to be the 18-month cycle trough, and then we'll have another 18-month cycle trough that takes us to the real 9-year low. Or if this is the 18-month cycle trough that has formed already, then we will see it bouncing up and coming down into the 9-year low in the middle of next year. But now, let me get back to the point that Nicholas brought up, which is that this 9-year cycle low might come early. And I would like to show you a very interesting chart. Before I do that, let me quickly see if I've missed any comments. David, at Trading Hurst, useful to use commonality with other indices at that point? Absolutely. In fact, that's something I'm going to show you in a moment, the concept of commonality. Commonality tells us that different markets move together, generally. They have a lot in common. And I'm going to show you an interesting comparison with an emerging market, the South African market. And I see some comments from William responding to John. Najmuddin, is there some way to assign a probability of our confidence if a trough is over a particular period? Okay, so Najmuddin, yes, that's an interesting thing, assigning a probability of our confidence. You know, there's an interesting thing that happens when you're performing a Hurst cycles analysis. On the one hand, it's a science, and on the other hand, it's an art. And so in terms of assigning a probability, you're probably saying, can I give a number to that? Can I say a percentage? Can I give a rating? And of course, CentiTrader, because it's a software package, a software application, and it uses numbers, CentiTrader does exactly that. It basically assigns probability to you know, to whether a trough is 18-month or 20-week or that kind of thing, and that's what helps it reduce this. Personally, I tend to find that assigning a number can be a little misleading, because what do you base your number on? It's a very complex subject, so I won't dwell on it here. But if you have ideas for assigning probabilities, then it'd be great to introduce them. But it can be a little misleading, so I tend to rather take an approach where I deal with the uncertainty rather than trying to resolve it, if that makes any sense. Okay, so speaking of commonality and other markets, I am South African, as you can no doubt tell, and so I've always traded the South African market, and I know not very many of you. I know we do have some South Africans who come along regularly to these webinars, but most of you, of course, don't trade the South African market. But I still do trade the South African market, and I find it very, very interesting to compare what's happening in the South African market to what's happening in the US market. And I'd like to quickly show you this chart of the South African market. Now, the first thing that might strike you is that it's a beautiful analysis. I don't know if I'm the only one that thinks analyses can be beautiful. What I mean by being a beautiful analysis is that, can you see how regular these semicircles are? I mean, the height of these semicircles, the rhythm with which they've been beating is perfectly regular. And so I really enjoy working with an analysis like this. It doesn't necessarily mean it's the correct analysis, I must warn you. But when I see a good analysis like this, I think, wow, that's really quite interesting. And so this chart goes back to 2008, 2008, and that's the trough in October of 2008, not March 2009. An interesting thing happened in the South African markets. They formed the really big trough that we've been speaking about in October or November of 2008, and much as the NASDAQ did in the American markets. Whereas, of course, the US stock markets formed the really important trough in March of 2009, just a few months later. But it's really quite obvious in the South African market that the big trough was in November of 2008. Now, I've applied John's short nominal model to this to see what it did, and I was really interested to see this analysis. Something has been bothering me for some time in the South African market. Can you note how up here what's happening is the South African market is forming a contracted triangle. Okay, it's more obvious than it is in the US markets, because the US markets have sort of failed recently and have dropped down below here. But the South Africans haven't. They've actually held up. And we're getting a very clear contracted triangle. Now, whenever I see a contracted triangle, or whatever you call it, a wedge or a flag, they're all very similar. But when you see that kind of pattern happening in the market, I do start asking myself, of course, whether are we seeing a mid-channel pause forming here? I always ask myself that question. It might not be true, and certainly not every single contracted triangle is a mid-channel pause. But I started asking this question of myself as this shape started forming, and I think it's a very interesting question to ask, because a mid-channel pause occurs at 2 degrees shorter than the trough that precedes it. Okay, so if this was a mid-channel pause, and I'm not saying it is yet, but if it was, then that would be implying that it's forming at around about the 9-year cycle trough mark. Notice how in this analysis the 9-year cycle has already occurred. Well, of course, it's a 7-year cycle because I'm using the shorter nominal model, but it comes back to what Nicholas said earlier. If this was a really important trough in 2009, then would we expect the 9-year cycle to occur early? Yes, we would. And so is it possible that in the South African markets, the 9-year cycle, or perhaps it's the 7-year cycle, has already formed? I think it's possible. It's an idea I'm throwing out there. I'm not staking all my life savings on it, but it's an interesting idea. And if that 9-year cycle trough has formed, then it has formed in what looks to me very much like a mid-channel pause. If that is a mid-channel pause, then it's a mid-channel pause of 9-year magnitude, which implies that the previous trough was a trough of not 18 years, but 36-year magnitude, which means that the trough in 2009 was probably a trough of at least 36-year magnitude. So we've come full circle, because I started off this webinar by speaking about how in the S&P 500, I believe the trough in 2009 was of at least 36-year magnitude. And here we're looking at a different market, potentially a mid-channel pause forming. And that would imply that a 36-year magnitude trough formed in 2009. When I saw this starting to happen in the South African market, that was actually what prompted me to thinking that the 2009 or 2008 year trough, in the example of the South African Johannesburg Stock Exchange, was a 36-year magnitude trough. So I put that out there as a really interesting point. What does this mean? Should we say, okay, the 9-year cycle trough has happened. It is happening early. Stand by for it. We should get ready. I don't think so, but it does raise a very, very interesting point. In order for this to qualify as a mid-channel pause, price, of course, needs to stay above this. It mustn't sort of break down below here significantly. So if price stays above it, and then starts heading upwards, then I am going to be not convinced, but I'm going to be more likely to accept the fact that this is a mid-channel pause, and that means that at many years of bullish stock market. John said in his analysis where we looked at the Canadian TSX, and I see he's put a comment there, the cycle troughs are much like the Canadian TSX because they're both very commodities based, gold, oil, that kind of thing. Not oil in the case of South Africa, but gold is very strong in South Africa. It produces gold. And so what that would imply is if price does hold up and keep going up, then we've seen a mid-channel pause of the 9-year magnitude, which means we're going to have many, many years of a bullish market. And John mentioned in his webinar about the Canadian TSX that he wasn't feeling particularly bearish. I think was his comment. He wasn't feeling particularly bearish necessarily at the moment. And certainly, if this scenario plays out, then I'm also not going to be bearish. I've been talking about and writing about 9-year cycle peaks for such a long time that sometimes sometimes you can say, okay, let me just clear this and show you. Here is definitely the 9 in the South African market. Having formed a 9-year cycle peak, you tend to imagine that now we're going to be going down for 4.5 years, but of course that's not how it works, because the 9-year cycle trough could form just a few months, or more likely a year or two after the peak. And so if that trough has formed, then we need to change hats again and start looking at a bullish market. I'm not changing hats just yet because this is the South African market, and sometimes, in my opinion, it can be a little deceptive. The US markets work better generally because they're more heavily traded. So there are more people trading it. The South African markets tend to be a little bit reactive to the American market. We're quite used to, as South Africans, quite used to the fact that our market bounces around a little bit, like a ball in a pinball machine, between the international markets. And so if the international markets do complete a strong move down into the 9-year cycle trough, then then I'm going to discard that idea of this being a mid-channel pause. So, in my opinion, there are really sort of two things that we need to consider here. The one is that the markets still have another 18-month cycle to go to come down into a 9-year cycle trough, and that could be quite a steep decline, because a move into a 9-year cycle trough should be a steep decline. On the other hand, we need to look out for the fact that a mid-channel pause is forming here at the 9-year cycle level. And it's not too late, because although I've mentioned that you expect a contracting triangle, have to be a contracting triangle, it could be any of the consolidation patterns, any market consolidation pattern. A mid-channel pause is simply a pause in price or a consolidation in price. And so if the move down into the 9-year cycle trough turns out to be little more than a pause in the way up, then we could expect some good bullish stock markets coming up. However, generally, I am still looking for price to move down into the 9-year cycle trough sometime next year. So that's certainly my outlook. If we have a minute, I'd quite like to show you something about the issue with counting cycles, because I think that's a very important point. Let me see if I've missed any other questions there. I see John saying it's interesting. I the major lows, the SPX has held very key levels. Absolutely, you see the S&P 500, has also held these key levels. It's just not coming down. As a cycle analyst, we expect our cycles to make M shapes, so it should be doing that, right? And when it doesn't make an M shape, it doesn't mean there's anything wrong with the cycle approach. It means probably that there are other cycles that we need to consider. All right, that's really what you need to start doing. When cycles don't come down and form their troughs, it's not because cycles have stopped working. It's because there are other cycles at work and they are distorting the shapes. And so if we, I don't know if I can possibly zoom this chart out, I can try. If this does turn out to be a mid-channel pause, then the cycle shape that we're looking at, there's the mid-channel pause going up there. Here's another mid-channel pause, and so then we're looking at something like that. Okay, don't take screenshots and bet your fortune on the fact that we're going to reach 4,000. I don't think that's likely to happen. Not soon anyway. When the cycle shapes aren't looking right, when they aren't playing out, it's because longer cycles are having an influence. That's a very big lesson that I've learned. Don't throw the cycles out of the window. Pay attention to the longer cycles, which is why I thought it'd be interesting today to take a bigger stack. Nicholas says U.S. markets are exposed to shale energy companies and the debt risk to banks with shale energy exposure. Yes, that all sounds very good. Yes, absolutely, and different markets are impacted by different things. Fortunately, it was a big relief to me to discover that as long as I could understand the cycles, then I wouldn't have to worry too much about the nitty-gritty. But absolutely, those are some of the reasons why markets move differently and so forth. Sid says, with the average PE ratio in the Russell 2000 at 150, I believe that it would make sense to explore phasing that expects much lower prices sooner than later. Right. So Sid is looking at more of a move down. I mean, I'm not saying that this is the definite option. I think it's an interesting idea, but certainly what we would expect would be prices coming down into this 9-year cycle over here. A stronger move down. Okay, and right. So, and John says the January lows are key. Absolutely, the January lows are absolutely key. We need to see what's happening now. We're in one of those situations where cycle analysts sometimes find themselves where as long as prices remain within the previous range, there isn't really much information that we can use. So we're looking at some key levels here. And so really just to summarize, I'm not saying that this is definitely a mid-channel pause. I'm not definitely saying that we're going up for a long time from here. I'm saying that it's an interesting possibility. A preferred analysis is still that we are heading down into a 9-year cycle trough, which I'm expecting some year. So I'm being very cautious because I do think these markets are vulnerable to quite a strong move down. That's my preferred option. But I do think it's interesting to consider the other option. And if the markets don't come strongly, but instead start turning up and picking up its speed, then we need to start considering the other option. And John says the one thing to watch is gold now, because if it makes any kind of significant top, stocks may hold up. Yes, absolutely. And John posted an interesting article. I hope that you've all had a look at it. Let's see where it's. I've got it here actually. Gold peak coming, asking whether there's a peak coming in gold. And unfortunately, we don't really have time in today's webinar to take a look at a detailed analysis of gold. but here is an analysis that I have running of gold, quite a long-term analysis actually. And here again you can see the 18-month and 40-week cycle peaks that are expected on this chart. And you know, those circles are really close. And a lot of people, when they start working with Sentient Trader and start working with Hurst cycle, they fall in love with the diamonds, and they love seeing these diamonds because the diamonds give them a sense of confidence. Everybody loves diamonds. But an important thing probably is to concentrate not on the diamonds, but to concentrate on these circles and whiskers, because they tell you what to expect. The diamonds tell you what happened in the past, and that's all very interesting. But it's what to expect that's really important. Trading, you're trading with your expectations. You're trading what's going to happen next. And this is not the same analysis that John was writing about in his blog post. You can see up here the circles for the expected peak of the 18-month cycle, or at least a long cycle, and that, according to this, is right upon us. It's the 18-month cycle. Still, the exact expected time of the next 18-month cycle peak is Monday, the 14th of March. So in about 3 weeks' time. 2 to 3 weeks' time. The 40-week cycle peak is expected in 3 days' time. Okay, so we're really close to that peak. So it's really important to keep your eye not only on the troughs but also on the peaks. As a matter of interest, you can see one of the dangers here of those cycles, because here we've got a 20-week cycle trough that might be out of place. Difficult to tell, really. If anybody has any questions about anything, I'd be very happy to answer them. But I think, and if there's anything else you would like to take a look at, then I'd be more than happy to take a look at it. I hope you found it interesting taking a look at a very different view. Normally, I normally I tend to focus on the short term. Crude oil, yes, Rajiv, let me show you. I've actually got a chart here with oil, although I haven't. It has updated data. So here's an interesting thing for oil. It, of course, depends what nominal model you're working with, but this particular analysis for oil indicates the trough that formed. Was it in January we had that low trough? This analysis indicates that trough was a trough of probably 40 weeks or maybe 18 months. And in fact, if I zoom in here like this, I can show you again. I've mentioned the problem with cycles, the counting cycles problem, and that's something that's happened over here, because here you can see the circle for the 18-month cycle trough over there, and here is a 40-week cycle trough that has been found. When that happens, that indicates that you really might have a problem with the identification of some of your shorter cycles, because this 18-month cycle trough is due very soon, and there's a disparity between your shorter cycles and your longer cycles. But this analysis of oil is indicating that we probably have one more downward. I think you can see here. You've got one more down drop before we hit the final low in oil. But that's a very staggered nest of lows. Can you see that staggered nest of lows coming into the 9-year cycle, coming to the 9-year cycle trough? The really staggered nest of lows. So it's indicating one more loop to it, one more sort of bounce, and then drop down into it. So we could be seeing lower oil prices later in the year for the big move up. I'm sure John has more to say about oil because he analyzes it more frequently, and we're standing by for a very, very important low, as mentioned in the webinar we did just about oil. We're standing by for that low. Whether that low was the low that formed in January probably still seems unlikely. I think there are still lower prices ahead. And as John mentioned in that webinar, we need to take a look at the FLDs. So let's just zoom in and have a look at how oil has interacted with the FLDs. You know, it's still a long way away from any FLDs that would prove that that trough has any strength in it at all. There we go. That's the trough there in January. It would need to cross up above those FLDs. So John says oil is key to watch. The cycle periods are dragging on. That's right. So we're looking for the trough. You know, Hurst tell us to expect troughs to occur. In terms of actually identifying, you know, when exactly that trough is occurring, remains more of an art than a science, in my opinion. You have to you know, look at all the details, and be careful of counting those cycles. You know, don't count shorter and shorter cycles. I myself sometimes with intraday trading. Here's gold, for instance. You know, I find myself sometimes with intraday trading counting the intraday cycle peaks and troughs in order to identify 80-day peaks and troughs. And you know, when you start doing that, you know that you're making a mistake. Be very careful of counting the shorter cycles. Keep these circles and whiskers active on your chart. Do you notice here how there's a 1-day circle right over there, and here this is gold. This is a 15-minute chart of gold, and there's a 1-day circle right over there, and look how closely a trough did form there. And here's a 5-day circle. So you see, I keep those circles active on the charts, and it helps you to know what to expect. So we're looking for an overdue 5-day cycle trough at this point in gold, and there was the 1-day trough that was due just a couple of hours ago, a few hours ago, and their trough did form. The circles and whiskers are your key. Avoid counting the shorter cycles and being convinced that that you're going to you know, reach the longer cycle troughs just because the shorter cycle are counting up nicely. Okay, let's see. Any questions? The longer cycles, the South African market was thinking about a different. John, I haven't looked at the longer cycles in the South African market purely because my data provider in South Africa provides limited data. But that's certainly something for me to look at. I'd love to hear what your different phasing is. I'd be interested in hearing that. Steve, the peak in gold in 3 days. I'm not sure what Steve is referring to there necessarily. Was it this chart that I showed you? Here we go. This is the daily chart. You can see even in MetaTrader 4, this is the Hurst cycles. Plug in MetaTrader 4. We've got an 18-month cycle peak, which lines up very nicely with an 80-day cycle peak, and that's expected. When is that? How do I do this? I go like that. That's expected on the 13th of March. Yeah, so the same as trader analysis, gold. So yeah, we're definitely expecting a peak soon. And as John says, a March-April peak for gold could still occur. Okay, so it seems it's very likely we're going to get a peak in gold in March or April. Whether the peak in gold has occurred seems unlikely. This peak over here is probably a little early, but you never know. The important thing is we are standing by for a peak to form in gold. And with that, I think I must bring this webinar to an end. Thank you so much for joining me, and I look forward to seeing you on next webinar. And in the meantime, I wish you profitable trading, of course. If you have any questions that I didn't get answering, please do email us and let me know. And I'll be very happy to email any replies. As always, of course, if you're a Sentient Trader user and you're interested in any of these charts, of course, we're delighted to share them with you. I can share the data and the analysis, and you can be looking at these analyses on your own machines. So let us know. Several people do always request the workspaces and so on. I'll be very happy to do that. So thank you very much. I wish you profitable trading.